look, there's not going to be a massive recession. We're not going to have a financial crisis. The dollar is not going to collapse. The world is not going to end. And being in a bunker is not going to be a good thing for you. But that doesn't mean that we can't have an economic slowdown or sub 1 to 2% economic growth next year because of the extraction of all this monetary liquidity from the economy. Slower economic growth is going to lead to slower earnings growth, and markets are not priced right now for slower earnings growth. So you have to be aware of that potential economic risk that's out there, because economics drives earnings and earnings drive stock prices.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap featuring my good and Vestal friend, Lance Roberts. How you doing, Lance?
Hey, Adam, great to be here. Missed you last week.
Well, we missed you too. We can see you got a new background here, so I'm presuming the move has gone well, or at least well enough.
Yeah, it's if I spin the camera around, all you're going to see is a lot of boxes and other stuff still. But we're getting there. We moved on Saturday morning, and so this whole week has been trying to unbox, and we've got a lot of it done. But the workers are still here, and again, just any moment now we may get interrupted by somebody walking through the house. But they're still trying to finish up all the last little bits of the house to get it finished. So it's been a process, but I'm sure Michael Leibowitz did a great job last week. And anytime he wants to have this spot, he is more than welcome to it.
All right, well, be careful on that, because audience really loves it when Michael comes on. But of course, they missed you too. We got a lot of good well wishes for you. So, anyways, folks, roll with us today. Maybe some surprises here on camera. But Lance, I reserved a little bit of the rants at the end here of today's discussion for any sort of moving sucks venting that you want to do. Anyways, I know the process is always, like a version of giving birth. So congrats on being on this side of it.
Oh yeah, right. Definitely so.
All right. Well, look, I picked the adjective vestal because if you remember your mythology, your Greek mythology, Vesta, and I got to be honest, I might be pulling the name of the Roman god, not the Greek god here, but Vesta was the goddess of home and hearth. Given that you're in a new home, Lance, thought it very fitting. And again, well wishes both from me, but from the whole audience that this new home of yours, this new house of yours, becomes a real home real fast. All right, we got a lot to talk about. And why don't we start with Nvidia, and maybe you can get your chart of the S&P up and ready, because I'm sure that'll be a good segue into that. But Nvidia came out with earnings the other day, and everything was good. I mean, the company is still growing at a ferocious pace, and had generally very optimistic guidance to give folks. But the stock has struggled. And I think the main reason why the stock is struggling, and you might have a different read on this, is that for the first time in over 2 years, its profit margin didn't expand. In fact, it shrank just a little bit. And I think people might be looking at this as, the moment when you toss a ball up in the air, when the ball hits its apex, hangs out and just begins to start coming down. Of course, that the ball is going to pick up speed from there. So there's a number of people who are thinking, hey, the AI mania probably was ahead of its skis, and is this the moment where gravity finally starts to take hold? So anyways, what did you take away from the Nvidia call?
Well, first of all, you got to really, look, it's easy to extrapolate a headline. It's like, oh my gosh, see, here's evidence that the AI bubble is done and blah, blah, blah. Look, you got to keep things in perspective. The stock is up 900% from its lows in October of 2022. It's up 140% since the beginning of this year. The stock was down 6% after earnings. I mean, to expect a bit of a correctional pullback is actually a great opportunity. I mean, if you haven't owned Nvidia, you may get an opportunity to eventually add it to your portfolio. It's still overbought, mind you. Even with this pullback, it's overbought, but it is slowly working that off. And again, just from a purely technical perspective, let's just look at a chart. You can see that, the stock has sold off. Actually, the stock has been just consolidating now really for the last really kind of June and July and August, it's been in a big consolidation pattern, which is healthy. And the stock does this from time to time. It did it back in March, April, and May before it got a next leg higher. We go back previously to this. It did it for a very long stretch in 2023. Really went kind of nowhere before it really took off. So again, it's always important to keep things in perspective. Now, we were, as portfolio managers, we're long Nvidia. We own shares in it. We've owned it for a while. But we take profits in it regularly. And from our original position that we owned in Nvidia, we no longer have any capital invested in it. It's all profits now that's in our remaining position. And
you're
in
playing
our
with
dividend
money.
equity
You got out your original investment. Now you're playing
right.
just with the gains you had. Okay, great.
Right. But another good example of this is just the magnitude of the move this year is that on January the 19th of this year, we launched the dividend equity model, which owns Nvidia in it. That dividend growth model has 30% of the allocation towards the largest cap weighted names in the index, which will give you S&P performance. Then the remaining 70% of the portfolio is allocated towards dividend yield. So you get S&P performance with a higher yield. It's basically like a high dividend S&P fund. But just since we bought that position on January the 19th, Nvidia is up in that portfolio over 80%. So, having a correction here is certainly likely. And look, and I absolutely agree. There's, going to be a slowdown, just the law of large numbers itself. If you're a 30 billion, if you're $1 billion company, growing to 2 billion is pretty easy. If you're 2 billion growing to 4 billion is pretty easy. So you can have these massive growths in revenue and earnings and those type of things when you're a smaller company. But now Nvidia is reaching the point at 30 billion plus in revenue. To continue to grow at that rate, you're going to slow. It's just a function. And yes, expectations from Wall Street, and this is always the habit of Wall Street, is they get overly exuberant, right? If you report 100% growth in quarter one, they go, well, if they did it in quarter one, they're going to do 150% in quarter two. And they always over extrapolate these things. And so it's very likely that, Wall Street's going to get disappointed from time to time with earnings. But again, Nvidia's had a very strong run since its bottom in October. It's pretty much tracking the technology index. And that's what you would kind of expect here. But again, we just got we got overbought on a short-term basis. This is a momentum chart at the top, and you can see that that run in Nvidia had gotten very extended in terms from trough to peak. It got extended on momentum basis, and we're now kind of working that off. And so, if Nvidia could get down to somewhere around $95 to $100 a share, which is where all the previous buying was, that's going to probably provide a pretty decent entry point to add back to our position in our portfolios. But
okay, and is that?
I was just saying, July,
yeah.
just to be clear, on July the 19th, we cut our exposure to Nvidia, and we cut our exposure to Nvidia last Monday before earnings, because we were worried that there was more. I wrote an article about this on Tuesday after we reduced that exposure, saying if you take a look at what's expected from earnings, there's very little upside. People are so optimistic about earnings, there was much more risk of a disappointment, which was the reason why we cut exposure further.
Okay, and I want to get into what I think is the article you're talking about. That was your one that was titled "Overbought Conditions Set Up Short-Term Correction." Is that the one?
That one, but no, that specifically, that was in our daily market commentary that we produce every day. But that's where we actually specifically talked about, reducing our position in Nvidia and why.
Okay, great. Before we leave this chart, though, so two things. One, if indeed Nvidia does get down, say into the 90s, there, down near the 200-day moving average, that you're saying that will likely be an entry point for you guys there at RIA?
Yeah, well, look, there's a lot of things that have to stack up. We're very optimistic on the company long term. Longer, I shouldn't say long term because things can change, but longer term right now, there is no change to the trend in AI. Data center build out still going very strong. One of the things that impaired, as you noted correctly, one of the things that impaired kind of the announcement was this shrinking of margins a bit on their products, but they're about to introduce Blackwell, which is their next generation chip. So Hopper's the one they're selling now. They're about to introduce Blackwell. There is much more demand for Blackwell than there is actual supply of those Blackwell chips. And that's going to be the case for a while. So we could very well see that profit margin contraction turn back into expansion, because that's just going to be a function of supply and demand for product. But this is why we also kind of back. This is just this is a 2% position weight in our portfolio. It's not huge. But this is why we also back this with our investments in utilities and other things that are going to be direct beneficiaries of the AI build out longer term.
Okay, got it. And the AI build out, I mean, it is staggering. I honestly think I can't fully get my brain around how big the spend is in this space. And there's a chart which I apologize, folks, I don't have on me at the moment, but I saw recently, which was the percent share of capital expenditures of really the Magnificent Seven companies on Nvidia chips. It was kind of a two-axis chart. It was that percentage, and then the other axis was percent of Nvidia's total sales, right? And you see two things. You see that a huge chunk of Nvidia sales are coming from the Mag 7 stocks. Not a huge surprise, right? But it is a very concentrated buyers group for them. And then you're seeing that, like I want to say like 40% of Microsoft's CapEx spend is on Nvidia chips, right? Which is a gargantuan amount of money, but it does raise the question, Lance, of sort of future growth, right? I mean, when you have 40% of Microsoft spend already, like there aren't many other Microsofts out there who are going to spend that much, right? So the question is, trees don't grow to the moon, right? So
I think this is the chart you're talking about, by the way.
No, it's a different chart than that, but I'll try, if I find it, I'll try to superimpose it here when I edit this.
Okay.
But I mean, I think that is kind of a valid point, which is, look, they just can't. The world isn't creating more and more Magnificent Seven companies who can then spend that much. Now, if Nvidia keeps coming out with a next generation chip that their embedded customers have to replace everything out that they had before with a new chip, yeah, they can keep this game going for a long time. But even you've said, at some point people are going to be like, hey, I had to buy the chips because I didn't really have a space in AI. Now I do. Now I can kind of get away with some of these older generation things, or I could buy some used products or whatever. And not everybody is going to be buying the exact newest chip the second it comes out, every quarter. So when people raise those concerns, what do you think?
Well, no, that's a very true statement. And so one of the things that we have to be paying very close attention to is there are numerous companies out there. So one thing about success is that success breeds competition. So at some point, you're going to have a competitor come to market that says, hey, our chip will do everything that Blackwell chips does for half the cost. So there is going to be the next Nvidia that's coming at some point.
Or sorry to interrupt, they might say our chips do 80% of Blackwell chips, but for 30% of the cost. And you might be like, oh.
and that could be it too. And so, the point is, and I think Walmart was such a great example of this just recently, is that they said that the money they spend on AI is giving them access to data and analytics and data analysis to control inventories and sales and those type of things that normally would take 100 people to do that. And so the move towards AI isn't just the Mag 7, it's going to be all large companies eventually that move in that direction. And then as more and more companies move in that direction, that's going to start to drag the mid-cap companies to compete. They're going to have to start investing in AI. Eventually, small cap companies will have to invest in AI. And so it's a structural shift within the economy. And Goldman Sachs just put out some research, I think it was last week, talking about that, in the future, by 2030, 2040, 2050, AI is going to replace up to 300 million jobs. So, the dependency on AI is not going to get any less. It's going to become incrementally more, but that also breeds off a lot of great investment opportunities. Again, one of the reasons that, we're buying into companies that provide electricity generation, natural gas, et cetera, that are all going to have to support the power infrastructure for those data centers. But this isn't a trend that slows down markedly overnight. This is a trend that we'll see develop over the next decade.
Got it. Interesting. You talked about the eventual potential of job loss, which we've talked about in the past from AI.
Yeah.
But I just saw an article, might have just been yesterday, about one of these kind of big buy now pay later companies, which I know we're not huge fans of, but Klarna is the name.
Klarna, yeah.
Yeah, and
Remember
they
seeing-
basically said, hey, look, we are laying off, thousands of workers now because we don't need them. AI has made us, that much more efficient, right? And it's sort of being looked at as sort of a hallmark of like, hey, there's been a debate whether AI is going to be a job eater or not. Here's some early evidence
I don't think there's any debate to that.
well, but so I mean, look, you and I totally agree with that, and we've talked about this before, and I'll just mention it again because I think we're going to have to, as a nation, come to grips with this sooner rather than later. Is Keynes is warning about technological displacement, which is economically you should replace labor with technology when technology can do a better job more efficiently. But if you replace the human capital at a faster pace than you can repurpose it to additional productive use, you end up creating a social crisis, the cost of which may be greater than the savings you're getting from the new technology. And let's just use your extreme statement there, Lance. 300 million people worldwide are out of jobs by whenever it was 2050. Is that what you said?
Yeah. But
okay.
that wasn't my study. That was just an article I was reading. I think it was from Goldman Sachs.
Right, but let's say that's right? Well, what's going to happen to GDP worldwide, which is heavily dependent on consumer spending, when that many people don't have incomes anymore, right?
Yeah.
And that's just economically. What about their lives? I mean, how are they going to feed themselves? All that type of stuff.
Well, no, this is exactly the point. And again, I'm actually writing an article for this for next Friday. So I've been working on this actual thing over the course of the last, really kind of week or so. But the article's talking about, these technological advances and do they really make things better? And so I went back and I pulled a chart of, all the tech, we're all focused on AI right now because it's like, oh, AI is the thing and it's going to be, but this isn't a new thing, right? I remember in 1980 when Microsoft was just getting started and there was NEC and IBM and all this other stuff. My dad came home from work and he's like, son, these newfangled computers, they're going to put me out of a job someday. And then it was the same way with the internet. And then it was the same thing with, FedEx and all this other stuff. Is that, we keep telling ourselves that these, these increases in technology are a good thing economically. And that, oh, well, it's okay if you lose your job, because if you were a FedEx worker, as an example, or you're you were a labor worker and now your job's been displaced by a computer or artificial intelligence or the internet or whatever it was, that's a good thing because now you go and get another job and you can make more money and do it. But that's never actually been the case. And so I produced this chart on the employment. It's called the Employment Real Situation Report. So again, we talk about employment, but this is employment growth from 1948 to present. And starting in about really 1990, with the adventation of the internet, employment growth fell below the long-term trend line and has never recovered. In fact, that deviation outside of the COVID crisis where we shut down the economy and laid everybody off is at its lowest level historically, other than that artificial moment. So, again, we take a look at the employment to population ratio. Clearly, we have, as we have these technological advances, those continue, that employment need relative to the population continues to decline, and corporate profits to wages has just completely exploded, because now I can do, as Walmart said, I mean, Walmart's such a great example. I can do so much more with so many less employees with the benefit of technology, whether it's AI or the internet or whatever else. I mean, think about all the things you do on the internet now that we didn't do, 20 years ago. You don't go shop at local retailers anymore. You just order stuff from Amazon, have it delivered to your door. Well, how many small businesses have we put out of business because of that, right? And and if you start thinking about, we used to have people that actually answered phones at offices, and we don't have that anymore. And so all those were jobs that were lost, and they didn't go re-educate and retool and become computer programmers. They just kind of faded into the population, right?
Right.
And
Did it improve that technology improve our lives? Or literally just yesterday, I was complaining about how maddening it is not to be able to get a hold of a real person when you have a problem at a company, right?
no, exactly right. And then I kind of conclude this article about social loneliness, because the advent and it's not just job loss that's been important; it's also been a societal drag. And especially if you take a look at what is really kind of what's happened in the economy, and there was a study out by Statista talking about how Gen Z is lonely, and 79% of them report loneliness. Well, this is the age that grew up with social media.
Right.
And importantly, it's led to a massive political divide between the right and left. So, and this is because of social media, right? We can't have an honest discourse anymore. It's just immediately hiding behind some, handle and just saying mean things to other people, whether they're
Right.
true or not.
And we don't have shared experiences. In other words, we're only consuming the content that reinforces our own biases. So we get so polarized. Yeah.
Correct. And then, of course, what's interesting is that since starting in 2009, 2010, by the way, that was when Facebook actually went public. The suicide
rate
rate
came out. Yeah, right around there.
Yeah.
The iPhone came out right around there, 2006, 7. Yeah.
Yeah. And ever since then, teenage suicide rates have been increasing sharply. So the point of the article is that, everybody says that technological advances make things better. But I think if you just take a moment and look around, you kind of start to realize that, yes, it certainly made things more convenient for us. And I'm not certainly arguing that. It certainly made us much more productive. A good example is just what you and I are doing right now. If there was just a few years ago, you and I could not create a video like this over the internet with just you and me.
Right.
I was talking about this. We run a radio show every morning at our office, and we're actually broadcast to a radio station, and it goes out across the city of Houston and surrounding areas. We also, at the same time, we stream that live to YouTube, so you can watch the radio show live. Now, that's just me and Brent. Brent Clanton is my executive producer, so just Brent and I do that all by ourselves. Well, when I started in radio at the turn of the century, that makes it sound weird. But I started doing radio in 2000. I met Brent Clanton. He was the operating executive at one of the Clear Channel stations here in Houston. And there was a whole long backstory that's actually hysterical that we'll have to go through sometime. But he finally acquiesced to my pressure and allowed me to start doing a radio show about finance and money on this radio station. Well, back then, to produce that radio show, just a radio show, it took 11 people.
Yeah, you need an army. Yeah.
Yeah. Between the producers and the sound people and everybody else, there was 11 people involved in doing that. Today, Brent and I, by ourselves, produce a radio show every day and stream it live. And yeah, we were just doing raw radio back then. So if you added a camera crew and everything else on top of that, it'd probably be 15, 20 people. So, yes, it's made us so much more productive and efficient. It certainly made our lives better. Yeah, I hate going to shop. I hate shopping, right? I would much rather just order stuff on the internet and have it delivered to my house. That's great. But it's not economically beneficial. And at some point, we'll never do this, unfortunately, until it's too late. But at some point, I think we have to step back and look at the technological advances that we're all buying into because they're cool and they're neat, and say, are these really making society a better place for all of us?
Yeah, it's going to be the difference between can versus should. Yeah, we can do it. Yeah. Really, should we do it? Do me a favor, pull your tech chart up. So you're hitting on like several topics I've been thinking about. So this is a great vein. But if you can go down to that first chart of the different technologies coming out.
Yep.
One thing I just want to note here is at most of those stages, the older people were like, I don't get this new technology, and this is this is going to be a bad thing for the future, right? But the consumer, the target customer, was super excited about it, right? So like TV, right? In the 50s, don't sit so close to the TV, you're going to go blind, you're going to rot your brain watching all this TV, right? Parents totally hated it, kids loved it, right? Same thing with video games, right? now when we get to the age of digital media, I was at a family gathering last night, and my wife's younger sister has daughters too. So we had two daughters, they have two daughters. My wife and I were old enough to be we were the cannon fodder generation in terms of managing children with digital devices. We were the first. There was no playbook. We had no previous experience to go after. And of course, the conclusion of our generation of parents was, oh my God, these things are terrible. We never should have given, them to our kids as early as we did. We should have had more safeguards in place, right? So my wife's sister, is sort of a generation after us, where they have the data. And she has a daughter that just turned 15 who had been, they'd been holding off for as long as possible about giving her the cell phone with social media on it. And they finally made the decision, you know what, she's basically telling us that she's, like a ghost at school, like just, she can't plug in socially with her peer set because she's not on these social media apps, and we're super reluctant, but we're going to give it to her. And she was just like, look, we hate this decision. Like, we don't want to do it. We feel like a gun to the head. We've got to give our kid this thing that we know is almost like kind of handing them digital heroin. And even the kid isn't super excited about it the way that we were about TVs or video games. It's like, when you talk to kids who use social media, they're like, yeah, I use it too much. I feel worse about myself after I use it. But there's just so much pressure, and so it's so ingrained in their society of kids who are trying to be social that they feel the cost of being out is higher than the cost of being in, but they don't like it, right? So we're at this point where kind of almost nobody likes the technology. Nobody's rooting for it, right? Nobody's rooting for Instagram or Snapchat or TikTok or whatever kids are using. So yeah, I think it's a really interesting commentary where it's like we're still going down this path, but really nobody likes where we're going.
No, and I agree. And look, and there's other drawbacks to this as well. And again, I know I'm sharing a bunch of stuff with you, but I put this on Twitter earlier this week, and this really goes to a bigger issue. So I've got an article out today on the website talking about Japanese style monetary policies that we're implementing here in the US. And I've kind of been on a big rant lately. The Friday before last, I was talking about, debt and what happens when you take on debt. So this week, we're talking about Japanese policies and kind of the end game of that. And if you take a look at Japan society as a good example, we have a lot of similarities to Japan, much more than probably most people want to admit. And yes, there are some differences, absolutely, from Japan, but we have a huge demographic problem. We have aging, an aging population, a pension problem, excess monetary influence problem. So we've got a lot of the same things that Japan has been doing, and they run about 30 years ahead of where we are economically here in the U.S. So it's kind of a good microcosm if you want kind of an experiment of what the future looks like for the U.S. Just go take a few minutes and spend some time looking at Japan, and it'll tell you a lot. But one of the issues that jumped out with this chart that I'm showing you is Japan has this problem with young people, is that they can't really get jobs. There's not, that they can't really afford to move out of a lot of them live with parents. They can't afford to move out. And so if you don't really have a job and you can't move out of your parents' house, it really doesn't make you real inclined to go date and do what's important, which is to both have children and form a household. And forming households and having children, of course, is what's very important to the sustainability and growth of an economy. And we're seeing that same problem here in the U.S. right now, because we have the lowest birth rate of the country ever since really the Depression, when, again, during the Depression, a lot of people want to have kids in the Depression. But we're back to that kind of same level. Women are waiting much longer in life for a variety of reasons. Some have careers and other things, but women are waiting much longer in life to have children. And in a recent survey, they were talking about that the number of children that people are wanting, it used to be, oh yeah, I'm gonna have a family of 4, then it went to 3, it went to 2, now we're down to 1. And so we're starting to see more and more young people going, I don't want to have kids at all. Because it's kind of a me generation. I want to be able to travel and do all these things. And so
or they just can't afford them. I mean, literally, kids are ridiculously expensive versus history.
Absolutely. But what I thought, and this just kind of plugged into this, but look at this is the worldwide dating app. So this is like Tinder, Grinder, Bumble, Match, eHarmony, all these type of dating apps. And the usage of those, and again, a lot of these have been turned into just hookup apps recently. My,
Right.
my daughter and I have this conversation, quite often because she gets frustrated. She's like, look, I'd really like to date somebody, but all they want to do is just hook up. Um, and the other problem is they don't have a job, or they all they want to do is play video games all the time, or whatever it is. But I thought it fascinating that since 2022, we did this whole COVID shutdown, we locked up the economy, and ever since then, as the economy's recovered and things were supposed to be getting better, right? We had this massive surge in wage growth, and people are supposed to be making more money, and everybody's just killing it in the stock market. But yet more and more people are no longer actually logging on to dating websites to go do what's important, which is to have dates and form relationships and build households, which that's going to economically, that is a negative feedback loop that shows up over the next 18 to 20 years.
So totally agree with that, and I want to build on that in just a second. There may be some silver linings on that, maybe not. I mean, I think the trend you're talking about is the big trend. So,
Yeah.
but in terms of the fall off since COVID, part of it might have been that during COVID, all you had to do, I mean, the only thing you had to do time-wise was just sit around and swipe, right? So maybe there was just an artificial spike with that, right? Even if you knew you weren't going to go out on a date, you're just still burning your hours doing that. But secondly, I was thinking of you when I read this story. Maybe there's a glimmer of hope here. So, I'm reading in the media that millennials, and particularly Gen Z, are beginning to swing back to physical in-person interactions versus dating apps, where they've kind of said, look, I've tried the dating app. I found it to be not very useful because it was just a hookup scene, right? And the way in which that's manifesting is at the gym. So, this is kind of a great story to hear, both because I know you and I don't like the culture of the dating apps, but also, we talk a lot about the health crisis we have in this country. And in general, Gen Z probably is the least in shape, at their age generation, at least of living generations. But there is a growing cohort that is actually really caring about their level of fitness there. And what this is doing, and I thought this would be near and dear to your heart, Lance, because you used to run gyms, is it's kind of blowing up the gym model. So the gym model is basically, okay, we're going to get a bunch of people who sign up on January 1st because they've made their New Year's resolution, and hopefully almost none of them are going to be using the gym after January, but we're still going to be charging them every month, right?
Exactly.
Well, Gen Z is showing up. So these gyms are like packed. So you have to like wait, 10 minutes to be able to use a machine. And so and for them, it's becoming the social place where it's like, oh, I can actually meet somebody here and have an interaction and maybe go get a coffee with them afterwards. And it's beginning to kind of replace the dating app. Meanwhile, all like the 24-hour fitness, Planet Fitness people are like pulling their hair out because they're like, this is blowing up our business model. We don't want you guys here all the time.
So yeah, I mean, but talking about this, yes, I agree with you that people are, young people. I mean, again, my daughter and son are the same way. They're going out to meet people. They're actually going back to bars. They're both in college towns, so they're definitely doing that. But the real issue, and again, ironically, right, as we were talking about before, look at the mark on teen birth rates, or the trend in U.S. birth rates. 2007 was the peak, which was right when social media went public. So, since then, more people are just spending time at home, swiping right, swiping left, not getting out in public. They're spending all their time on social media trying to, create videos or whatever they're doing, and playing video games, etc. Then that's fine. I'm not, saying that, doing those things is a terrible thing. If that's the way you want to live your life, that's awesome. But again, we go back to the kind of earlier charts I was showing you about the trends in teen loneliness, the teen suicides, Gen Z loneliness, and then take a look at the birth rate decline that just immediately starts when social media becomes a thing in the U.S. I mean, we're all angry at everybody. We're all divided. Nobody likes anybody anymore. can't talk about anything because you might offend somebody. And this is not a good result. Demographics are destiny. And without demographic growth, the economic growth cannot follow. Economic growth is highly tied to your demographics in your economy.
So totally agree, and we've had this conversation before, and just want to remind folks that if you're really interested in this, go look at the video that I did with Chris Hamilton, the chartist. He does a lot of demographic charts, but we go into this whole topic in depth, and the numbers are super concerning. And so, Lance, I do think that this is sort of it is an existential question that the U.S. and much of the West, not even the West and the East face right now. Japan and China are even worse shape demographically than we are. It is a massive, massive problem. So I'm not trying to sell sunshine here at all, but it was just, I just wanted to note some of these, little silver linings we're seeing. I do want to say though, that it's not just social media. Social media is as toxic and is playing as big a role as you say. It totally is. But remember what else happened in 2007? We were falling into the great financial crisis. We then had all the QE and rescue efforts after that basically exploded the wealth divide, increased the cost of everything, and have made the ability to form a family much, much harder. So there's multiple punches going on to the younger generation trying to that would otherwise be trying to form a household right now. So there's a lot going on that head in the wrong direction. Yeah.
No, absolutely. And look, that's a key point that so this article that I have for you, I guess we won't talk about it next Friday because we're talking about it now. But, that was a key point of this whole article is that when you look at, the employment situation, et cetera, it's household net worth by brackets, which, the top 10% of income earners own about 90%, 80% of the entire household net worth. The bottom 50% barely even show up. And this is, and they didn't register at all until really about 2017. So the kind of the booming market since 2017 through now has certainly helped a little bit. Their 401ks or whatever small IRAs they have certainly improved in value.
It's probably mostly homes, but yeah, go ahead.
Yeah, and that's probably mostly homes. Same thing for the middle 50 to 90%. But when you start looking, and again, exactly to your point, technology has been great. If you're in the top 10% of income earners and you're investing in the stock market or you're investing in the technology, or you're the business owner that's using the technology to increase your profitability, this is great. If you're the laborer and you're the person providing the labor for these companies, as we showed, it hasn't been great. So it's massively dependent about where you are in that demographic makeup of the economy.
So sorry, pull that chart back up here because I wanted to come back here. So yeah, that's a key point about capital versus labor, which is capital has been losing that battle pretty much through the entire data series you have there in that chart.
Yep.
Right, past half century, right, and basically getting worse, right. And when we talk about what AI could unleash, maybe even a lot worse from here, right? There was a tweet, it was a topic I kind of had reserved maybe for the rant, but I'll pull it up here. Let me read this tweet. And this is just one of many, many comments that I get from readers on social media. My aunt in her early 60s, her father was an illiterate auto mechanic. And in the 60s and 70s, he was able to buy a home, had a stay-at-home wife, a car, raised 2 kids, and had a seasonal RV spot when the kids were teens. My husband is an MRI tech, and we can barely make it work, right? I think it's a very, very common story in today's world. And as technology, as the division between disparity between capital and labor continues to increase, we've had to do things like have 2 income households and things like that we're running faster and faster to try and stay in the same place. Now we're running faster and faster, and we are falling further and further behind, right? Again, unless you own capital, and then you're in that top 10% you showed that basically is increasingly owning the entire pie, right? And I don't think anybody wants to go into that future unless you're in the top 10%. And even you guys, we'll have trouble at some point. There will be some breaking point where the bottom 90% just says, hey, no more, right?
But
So,
look,
yeah,
but but this is a super important point though about why you're doing this show, right? So
absolutely.
we're talking about these things, and the whole takeaway here is that the reason that you're watching this channel is because you want to invest capital, and this is as we've talked about before. Our job is to invest capital in a manner so that we can be in the top 10%, not the bottom 90. So this is why we want to. Yes, these things are very important, and they're very important to the long-term outcomes of the economy and to the wealth of individuals across the country. And you have a choice. You can either manage your capital in a way that will keep you in the 80%, the bottom 80%, or you can manage your capital in a way that will get you in the top 10 to 20%. That's your choice. And so those decisions that you make, how you spend money, how you save money, how you invest money, how you look at how you invest money, and the policies and processes that you use to manage that money will be the determining factors between whether you're in the bottom 80 or the top 20.
I'm really glad you said that, because that is the whole reason why you and I get up in the morning.
Yep.
And we do different components of it, where both of us do the educational part of it, but you actually do the practical part of it as well, which is if somebody doesn't trust or want to be the one managing their money and have somebody smarter than them do it, they can knock on your door. But yes, I think mission-wise, Lance, we're trying to help educate so we can wake the world up, and hopefully the world will make better decisions going forward. But I don't think you and I have any illusions that the world is going to change overnight because of what Lance Roberts and Adam Taggart thinks. So we're trying to do the one person. Let's get as many people into as many lifeboats as possible. Let's get as many people on the right side of that line. And hopefully through our efforts and the efforts of other people like us, and as more and more people wake up, we eventually over time help change society for the better. But in the short term, it's very much a put your oxygen mask on first type of thing, right? Get as many people to do that, and then they can be agents to help other people. So I want to go ahead.
I want to clarify that last point, which is you're absolutely right. But the point that what I don't want people to do is to walk away from this video and go, well, Lance said the world, the economy sucks, and this is all going to happen. We're going to become Japan, so I'm not going to invest. If the world's going to crash, I'm not going to invest. That keeps you in the bottom 80%. Right?
Agreed. Yep.
The top 10% of the economy, they're investing all the time, no matter what is going on in the world, because there's always an opportunity to make money. And again, the whole job as an investor is to take advantage. Unfortunately, right? I'm not saying this is a good thing. This is not a good dynamic of the market. But the market's job is to take advantage of other people's plight. That's what they do. And so you have to get you comfortable with the fact that I'm going to invest in companies that are taking advantage of other people, because that's what markets do.
Okay. I'm sure we're going to get some people, pushing back from the socially responsible investing standpoint, and there's nothing wrong with that, but you may be trading off return for ethics, which is fine, right? All right. So just to close the loop on our conversation here, when you were talking about Japan and how it's showing us where we're going, and also overlapping that with AI, I just want to note an issue that may make this whole AI thing even worse, which is, there's a lot of data out there that has said, has showed that a lot of the unintended consequences of a lot of government largesse creates dependent classes, right? And we have had a real deterioration in family formation, especially in lower opportunity parts of society. And a reason that's used to explain that is that the spouse oftentimes, with women, we've had a lot more single mothers out there, broken households, a lot more single mothers than single fathers raising kids. Both there have been cultural trends and economic trends that have allowed, and painting with a broad brush here, the guy to say, hey, I'm out of here, but also for the woman to say, hey, my husband's not doing very much for us, and I can get support to raise my kids. I'm going to drop that loser, right? I'm trying to be very delicate here because there are lots of good reasons to do that oftentimes. But the saying that comes out of this is that it has allowed people to divorce the bad spouse and marry the state, right? And that has deteriorated family formation. In many ways, it has created a lot of societal outcomes that I don't think we want, right? And of course, this is a big hairball because it's like, well, you're saying we should cut benefits to these people that really need support, but in a lot of ways, it's the benefits that are enabling this stuff, right? So let's look at the AI situation you talked about, where corporate profits go through the roof, maybe government's able to tax some of that, whatever, but you've got hundreds of, in the US, tens of millions, worldwide, hundreds of millions of people out of jobs displaced by AI over the coming decade and a half or whatever it was, right? To me, it sort of seems like that might be that same, don't get married, marry the government on steroids, right? Where it's like, well, hey, if I can get my MMT or whatever, right? If I can get my stimmy check from the state and I don't really have to go pull a job, yeah, all right, fine. Let's sort of slouch into this future, and we end up having a massive part of the population all of a sudden become unproductive, dependent, raising increased dependence, future generations of dependence. I mean, I'm not saying that that's exactly what's going to happen, but that I think is a very valid question to say, wait a minute, are we creating the environment for this to come out of it?
But it's not just AI doing that. It's the policies that we're voting for, right? So we got a very important election coming up in 60 days, basically. So you've got two very different sets of policies. One is basically kind of more of the support, more child tax credits, increased tax credits, those type of things, more support for the economy. The other is hey, I want to cut taxes and go back to creating deregulating the economy and allowing the economy to function for itself. So two very different sets of policies, really kind of across the board. But if we look back, things like increasing child tax credits, it all sounds great because it's like, oh, we're going to help. Look, we're the guys, like as Ronald Reagan once said, the most fearsome words are, "I'm the government, I'm here to help," right? And this has been something that really over the last, this isn't new. This isn't something that just started in 2020. This has been going on since 1980. Is that the government has taken on more and more of a role of what are clearly socialistic type policies, where the government takes on more control, more of the role of the provider.
I would go back to the Johnson era. In fact, I mean, you could go back to Roosevelt too, but yeah.
And you really could. The invention of Social Security, and then in the 60s, we started adding widows and orphans and everybody else to Social Security. And Social Security has become basically a drop safety net for any type of, aggrieved party in the country. It's like, okay, well, they need help, so throw them on Social Security. And of course, Social Security has a big funding problem now because of that. But the issue is that none of these policies actually make things better. They make them worse. Good example. Child tax credits is a great example of this. In 2020, during the economic meltdown, we started sending checks to households, and government started passing, all these extra tax credits and things like that to help Americans out that were displaced out of jobs. The Biden administration said that these policies will lift the bottom 20% out of poverty. And I wrote an article immediately after that saying it is true. These policies will lift America out of poverty for 1 year. And of course, now there are more people in poverty than there were back then before we actually did all these policies. Why? Because if I say, Adam, I'm going to give you more money for childcare, and Adam goes, great, this is awesome, right? So I'm going to get more money to pay for childcare. So Adam says, I'm going to go get more childcare for my kids. Fantastic. Who else knows that Adam's getting more money for childcare?
The childcare providers.
So what do? They lift their rates. And so now you pay more for childcare. And so the problem with all of these policies is that it doesn't actually benefit you. It actually makes things worse over time because the cost of whatever you're benefiting goes up as much or more than the cost of the tax credit you're receiving. And that doesn't moderate. And in fact, it keeps going up because of inflation every year, but the payment, the tax credit, it doesn't increase for inflation every year. So it becomes a disparity over time that becomes more of a burden on potentially, and most importantly, a burden on those in the lower 40% of income earners who are the biggest beneficiaries from all of these social policies. And so, we really need to go back as a country and examine what these social policies are and say, what are we doing with this money? Is it actually benefiting people the way it's supposed to benefit, or is there a better way? And, a good example also comes around to the fact that, post the, 2020 shutdown, we had this massive surge in wage growth, right? This is a good example because, we needed to hire people to go work in fast food work and all this other type of stuff. Well, now employers are now reversing all of that. The amount of pay for new jobs are dropping sharply. There was a great article in the Wall Street Journal either yesterday or today, talking specifically about this. But if you go on and you're looking for a job, those salaries are being cut sharply. Those offering salaries, previous signing bonuses and other benefits are now no longer available. There's a good example of a McDonald's franchise owner who owns like 26 different McDonald's, and he's pressuring his managers to get wages down to $12 an hour. So, and down from 13, 14, 15, which remembers where everybody was trying to get to. So there's this pressure on lowering the wages that were a direct a direct byproduct of what happened during that pandemic shutdown, because now the cost of labor are exceeding the profitability of the companies, and they have to start cutting labor to get profitability back in line.
And that's why your hamburger is $20. Yeah, because
exactly
the labor component has become a huge part of it.
Exactly. And everybody wants to blame, the stimulus checks and look, the stimulus payments, the direct stimulus payments household are a big factor for why you had 9% inflation. The reason that inflation is going to take a lot longer to go down is because of all the subsequent policies that we've done that are having to compensate for the cost of business. Inflation is just a function of companies have to maintain some profitability over the cost of running their business. Otherwise, they're out of business. And this is a big fallacy that California is starting to discover now with $22 hour wages, that businesses can't stay in business, and they're having to figure out different ways to cut those costs, either leave the state, automate, whatever it is. But that's hurting all those people that were supposed to benefit. And this is my point, is that all the people that are supposed to benefit from all these social feel-good policies are the ones that get hurt the most.
So absolutely agree. And certainly on the policy side, I do want to just sort of underscore my point, which is I could see the potential for AI to be kind of like a phase change event here that just makes things a lot worse, a lot faster, if it indeed displaces a ton of people on a very short time frame, because then politically, it's hard to see the type of politicians we have right now doing anything other than, well, we have to send a ton of money to these people to support them, right? Which just makes this potential, what we're talking about, potentially honestly, a lot worse.
Look, and that's honestly what government wants, right? The government wants to be a nanny state, right? That at least a lot of the politicians today that are pushing for these more social agendas, this is about a shift of power, right? So the more the government can control, they would love to have a nanny state, because what a nanny state provides is more control over the population, and it shifts the wealth from the poor to the rich. So those in power get more wealthy. This is why every socialist country in the world eventually, devolves into some, anarchy at some point, because the wealthy have all the control, they have all the power, they have all the wealth. Everybody else is struggling to get by. And the unfortunate thing is that you can vote yourself into socialism. You have to fight your way out of it.
Yeah, so I was just talking about this in the interview that just released before this one with Lacey Hunt, exactly this. I mean, sadly, what politician of the ilk that we have right now wouldn't vote for more power for themselves, right? I mean, I think to a person, they probably would, right? But Yeah, and so I was talking with with Lacey about this, which is like, hey, what's crazy is we're beginning to get to the point where we're starting to consider policies that do sort of sound like they're straight out of the socialist playbook or even the communist playbook, and it's like,
Yeah.
history is replete. It's got a perfect batting average on how these regimes end, right? And even today, like we only need to look a couple miles off our southern coast to Cuba, which I don't know if you've seen the recent stories from there, but Cuba is in a massive world of hurt right now because they now have this aging population and they've got no resources left to support them. You have people that are existing on like $10 a month there, right? You can't get any health care. And it's the natural end result of these
Well,
policies that we're talking about.
well, the one I did a Fox Business interview last week, and that was a question that was asked to me because that was right after Kamala Harris had come out talking about price controls. And I was asked, I said, what's your view on price controls in terms of economic growth? I go, you don't need to ask me. Just go look 90 miles south of Florida and see what price controls turns out to be. And this is exactly one of my points, right? Is like this, price controls sound great, right? It's like great, we're gonna cap prices on stuff, so that's going to solve the inflation problem. No, it doesn't. It makes things vastly worse when you start price control because the things that you're price controlling you can't get anymore, and the things that aren't price controlled go through the roof. And so if you think things are bad now, try some price controls and see how that turns out.
Yeah, they never ever work. And if you want to understand sort of the economic reasons why they don't work, watch the video with Lacey. He actually goes through that.
Oh, good. Yeah.
But to Lacey's point, or sorry, Lacey's main point of the whole video was like, it doesn't matter who wins in November. He's like, and even just looking at the different policy, the policies of both parties are very different. So don't get me wrong, but he's like, both these, looking at the economic plans as best we understand them right now, he's like, these guys both have a ton of expensive programs that they're going to be spending for and no idea how to fund them, meaning both parties, whoever wins, are going to make our debt problem even worse. And that's the big thing that's going to get us in the long run. So one thing last on the policies, and then we'll move on. So I just recorded an interview with demographer Neil Howe, Fourth Turning fame. That's going to be the video coming out, 2 videos after this one, so early next week. But what he said, just to expect, not necessarily to make us feel optimistic, but and it's interesting because this does make me a little optimistic, although I know there are going to be elements we're going to hate about it. Is he said, look, right now the regime is old, right? That's what happens in a fourth turning. The old regime, starts falling apart, right? And he said, right now what we're doing is we're basically borrowing from the future, right? That's what deficit spending is. Right. So we're trying to enjoy prosperity today. And the only way to do that is we can pull it from the future, right? Using deficits and deficit spending, and which becomes debt. And of that prosperity we pull into the future, we're sending that mostly to the old, to seniors, largely the boomers, right? So when you think about what the government spends most of its money on, the big 3 are what, Lance? They're defense, Social Security, and Medicare. And you only get Social Security or Medicare if you're over like 65.
Right. Yeah. No, that I just did a piece, and I don't think people really understand exactly, what they're voting into. And I think this is the big problem. Look, even our politicians do not understand basic economics. Some of the stuff that I have heard come from both parties, by the way.
You say that like that should be surprising. Anybody that knows anything knows that most of them have no understanding of economics.
Right, but if you're running for government, right? Especially if you're running for the presidency, you should at least have a basic understanding of how economics work. And what surprises me is that there's such a I don't know if it's intentional. Yes, probably. But there's such a problem with this idea about taxes and we just need to tax the rich. Do you realize that we founded this country on this whole idea that we wouldn't have taxation without representation? The reason we had everybody came here from England to start with was because they were being taxed to death. And so when when our founding fathers and the original people came here to flee England, the goal is no taxation without representation. The first income tax was a tax on the wealthy. It was 3%. tax on the wealthy. And the problem is that all these taxes sound fantastic, right? It's like, oh, we're going to tax the rich. Let's tax the rich. Let's go get those guys because, they're the ones that are hoarding all the money, etc. The problem with that is that whenever there's a tax on the wealthy, it becomes a tax on everybody. And it's never just a tax on the wealthy. That's just where it started. That was the big lie. And so when they say, oh, we're going to go raise taxes on the wealthy, no, you're not. You're going to raise taxes on everybody. And not necessarily from the fact, well, Lance, the actual tax bracket didn't go up. No. What happens is if you tax the wealthy, they're most of the producers of income, right? The wealthy are the ones that own the vast majority of the businesses. They do most of the employment. That's where their wealth has come from. And so when you raise taxes on them, they raise the cost of everything else on you.
Pass
So
it through. Yeah, exactly.
So you may not, directly pay taxes, but look, you're now if you're just a normal everyday American citizen, your tax bracket runs 15 to 35%. So that's a lot more than the 3% on the wealthy, from 150 years ago. And so, these taxes bleed over. And as you get taxed more, then everybody says, well, we taxed them a little bit. Hey, let's tax them some more because we want to pay for all this spending that we want to do. And I don't think people really kind of grasp this point. I did this article just recently talking about UBI, universal basic income, and why it didn't work and why it doesn't work. But, if you take a look at where your tax dollars go, there was a statement by the CBO. This is the Center on Budget and Policy Priorities, the CBPP. Sorry, not CBO. But they made a very interesting statement. 90% of every tax dollar that we spent in 2023 went to non-productive spending. So again, that's spending that we're doing on things that just eat up capital. So your tax dollars just basically disappear into a void if it's non-productive.
Right. And let me just chime in. This is why Lacey Hunt talks about the government spending. When you start government spending from a low level, it's stimulative to the economy. But once it gets to beyond a certain amount, it begins to become a net drag on the economy. And this is exactly why.
Right. And then here was their interesting statement. I want you have to do some simple math in your head real quick, but about 9/10 of the total went towards federal programs. The remainder went towards interest payments on the federal debt. Here's the math part. Of 6.1 trillion in spending, only 4.4 trillion was financed by revenues. You're spending 138% more than you're bringing in. Now, that's, the problem. This is why government debt continues to spiral, higher. And a lot of this has to do with the fact that we don't pass a budget anymore. Right. Since 2008 under the Obama administration, I've talked about this before with you, but we use continuing resolutions to fund the government. Well, that automatically increases revenue at or expenses at 8% a year across every program. There are no cuts. Everybody gets 8% more. And so if you just do the rule of 72, every 9 years, you're doubling your spending.
Yep.
Right. So, but again, this is, it's the lack of understanding of most Americans when they go to the polls. They vote for what sounds good rather than what is good. Right?
Completely agree. Yeah. And just to put a fine point on your charts there, that is why one of the things we can have the greatest confidence in is the continued decline in the purchasing power of the dollar, because it's going to require additional debt issuance to basically fund that difference going forward, right? And the casualty of that is the purchasing power of the currency.
Which, going back to what we said earlier, is why it's so critically important to invest your capital properly so that it outpaces the decline of purchasing power. If you're in the bottom 80%, you live and die by the decline of purchasing power. If you're in the top 20%, you don't.
Right. And as we've talked about, the number one thing you want to do as an investor, we'd all love to get filthy rich, but really the realistic goal for the investing side of your efforts is just to stay on track with inflation and not have your wealth be eroded by it. All right, so
just go broke, or if you actually want to just go broke, remodel a house like I did. So there you
go. Well, I'm trying to get to the rant, which I'm going to let you loose on that. But just to finish the point that I was making about Neil Howe, because you took the football, but you took it in a good direction. But he basically said, look, we're stealing from the future, and of what we are receiving, we are giving that to the elderly, and that's where the power structure lies right now, right? And you just look at Congress; it's a gerontocracy, still, right? But that can't last forever, and that's not in the best interests of the nation. And we talked about the plummeting growth rates and birth rates and whatnot. So he said, we will. He believes we will see the pendulum swing from favoring the old to favoring the young going forward. And I just want to get this out there because I think if you're a Gen Z or a millennial watching, maybe this is the first bit of good news you've had in a long time around this. And if you've got kids and have been worried about their future, maybe that's a hope you can hold on to. And like I said, I feel kind of optimistic about that. Like basically Neil says that's kind of what happens in a fourth turning. So we should expect this. Now there's going to be a ton of spending that comes along with that. Maybe spending we can't really afford. The swinging of that pendulum is going to be messy, and it's going to be imperfect. But we will set ourselves up for a fourth turning where the younger generations are in a better position to step forward into what new, better model comes from here. So I kind of hope we can all hold on to that, realizing that may be the greater good that comes out at the very end, but there's probably going to be a lot of pain and a lot of messiness, in the process there. And if you want to learn more about that, just watch the interview with Neil. All right. Well, look, it's so funny, Lance. I mean, again, I've looking at all the bullets I prepared, and we didn't get to almost any of them because I never know where these conversations are going to go, but they always go in really useful.
Well, we got some time. We got some time. Let's do speed round. You asked the question. I'll give you one sentence.
No, we're okay here. I think I'm going to land this plane more with less turbulence than that. I guess first, let's get to trades. What trades have you guys done? Have you been able to even focus on doing trades while you've been unpacking and moving all your boxes?
Of course, the moving never interferes with managing money. That always comes first. So a couple of things that I talked about it. We didn't do a whole lot over the last really couple of weeks. The market's been rallying very nicely. We had the yen carry trade blow up three weeks, almost 4 weeks ago now, come Monday. And we had already de-risked a bit going into that sell-off because markets were starting. We had been talking about, you and I, June, July. We're talking about the 5 to 10% correction was likely, and so we'd already kind of de-risked portfolios a bit, and so we had that correction that worked out well. So we didn't really have to do a whole lot. The only thing we've done recently is we did sell a little bit of Nvidia on Monday before the earnings announcement, just because of concerns about there was almost nothing they could say that was going to make Wall Street completely happy and send the stock up 10%. It's just there was so much optimism that the risk just was really to the downside for that earnings announcement. So we just de-risked that position a bit. Now on Friday, we actually started a position in Annaly Mortgage, and it has current yield about 13%. There's a few mortgage REITs, and you've got to be careful with mortgage REITs because some trade above book value and others don't. So if they trade above book value, they're more inclined to issue shares at that point. So you've got to be careful kind of which mortgage REIT you choose. We chose Annaly Mortgage. So, but Mike, again, this is kind of Mike Leibowitz's bailiwick since he used to work for Fannie Mae. We ran all the analysis and have started a position in Annaly Mortgage for one reason only, which is that when the Fed starts cutting rates, not initially, it'll take a while, but as the Fed starts cutting rates, that will increase the prepayment speed of mortgage-backed securities, which is a net benefit of the refinancing activity, which is what benefits companies like Annaly and PennyMac and others. So agency is another one. So so this is kind of a play on adding dividend yield to the portfolio. We added it in all of our models. We bought in the 60/40 equity model, we bought Annaly, and in the ETF model, we bought a mortgage REIT ETF called REM as a symbol on that one. And then we bought Annaly in the dividend equity growth model as well. So it's just kind of a play on Fed rate cuts. And as it starts to work out, we'll add to that position. But overall, the portfolio's done very well this year. We're at an all-time high in the portfolio value. The market's not. So, we're kind of doing, the portfolio has performed very well this year. A lot of that has come from our bond positions that we bought previously. We've had a very good run in bonds this year. We expect that to continue. But as I stated before, bonds are extremely overbought. You can't buy bonds here. They need to have a correction. And there'll be some news item that comes out or whatever it is in the course of the next month or two. We'll start to see maybe oil prices tick up. There'll be some concerns about a return of inflation. That should bring bond yields down interest rates down and bond prices down. I'm gonna spit that out right here in a second. If we see, these concerns of inflation rising, that'll make interest rates go up and bring bond prices down, which will give us a better entry point. And that way we can start to look at shifting our duration of our bond portfolio accordingly. But again, we're not there yet. And if you're trying to buy bonds, it's not a good time to do it. They are so overbought right now. You're kind of jumping from the frying pan into the fire.
Okay. Great. It does sound like if you get the correction in bonds that you expect to, you will increase your exposure to them.
Well, no. So no, our bond so if you look at our bond portfolio, so in the 60/40 model, we have a bond sleeve and an equity sleeve, right? So our bond sleeve is about 10% underweighted bonds, period. So we have about 30% of our bond exposure of 40% of a target. Of that 30%, the vast majority of that is very short-term T-bills and shorter duration bonds between 1 and 7 years. Then we have a piece of the portfolio that's about 10% that is long duration. So what we'll start initially doing is moving the 1 to 3 year bills into 5 to 7 year bills, and then we'll move some of it and start increasing duration there before we start creating duration on the long end. The long end will start to increase once the Fed gets really aggressive about cutting rates.
Okay, so this is where I want to take it. But first, for folks that are taking notes, the mortgage company you guys bought was Annaly Mortgage, and that's ANNALY, correct?
And symbols NLY.
Okay, NLY. All right. So you've already kind of given at least a partial answer to the question I'm about to ask, but I've been asking this of other people recently, and I just realized I haven't asked it of you. So the Fed has officially pivoted pretty much at this point in time, right? Powell basically said, time's come to change policy. That means we're going to start lowering rates. 100% probability as measured by the markets that the Fed is going to cut in September, right? Just to debate whether it's going to be 25 basis points or 50. The majority is still on 25 basis points. If you look at the Fed's dot plot, I think it's planning to bring the Fed funds rate down by about 100 basis points over the next year or so. If you look at the market's forecasts, it's a little over twice that.
Okay.
Right? So basically, we appear to be poised for material cuts in the Fed's interest rate, right? And look, I'm not talking about a recession that could speed up the timeline here even. So let's put that aside for a second. So if you think that the federal funds rate is going to come down, somewhere between 100 and 200 basis points or 200 more than 200 basis points in the next year, there's a lot of money that is parked in T-bill and chill.
Yep.
So it raises the question, if you start thinking, hey, the T-bill and chill game may be over soon, where do I put that money next? Right?
And that right there is the problem that you and I discussed a year ago when we talked about this whole idea of T-bill and chill, is that you're going to get to the point to where it's like, okay, my 5% T-bill is now 2.5%. Where do I go? And there's going to be nowhere for you to go. You can't go buy bonds, long duration bonds, because they'll be way too overbought. You've already lost the vast majority of the return of long duration bonds. You won't want to own stocks because they're going to be overvalued. So now, and this is why, that's why we were buying bonds when everybody else hated them.
Yep.
And everybody else was criticizing them. That's why we were buying the bonds, because it's like, once you lock yourself into that T-bill and chill for 1 or 2 years, when that 1 or 2 years is over, you're going to kind of be completely screwed as to where to go to next.
So Yes, and I want to give you full kudos for both making that warning, getting into bonds, holding into bonds when that trade wasn't responding early
Working.
on and
It
people were
wasn't
questioning
working.
you, right? Yeah. So this, folks, again, this is what a good financial advisor does, is they have a thesis and a plan, and as long as the data that's informing their thesis hasn't changed, they stick to the plan, even though it can be
Painful.
unpopular to do so in the short term, right?
No, let's call it what it is. It was painful. It was
Painful,
painful.
painful. You're right, and those that do ride their T-bill positions down to say 2.5, will be experiencing that angst when that time arises, right? Now, but let's game this out though. So there's time between now and then, right? We're still above 5 right now. We're not at 2.5%. Most of the folks I talk to don't think too many folks are going to change their T-bill and chill positions with a single rate cut, or maybe even 2, or maybe even 3. Yeah, you know what? I miss getting 5 over 5, but I'm still getting 4.5. That's okay, right? But there's going to be some inflection point in there where the herd starts to say, you know what? I think it's going even lower, and I don't want to ride it down, right? So where do you think that money is going to go? And I'll seed the question by saying, I can make a case that a pretty substantial part of it will probably say, well, I'm going to go out the duration curve, not necessarily to try to gain capital appreciation, but just to lock in whatever they can for longer, right? I love getting 5% and being able to roll it over every month. Yeah, okay, now I'll get 4% or 3.8 or whatever for the next 3 to 5 years, and I can live with that, right?
Sure. Well, and again, that's going to be the choice, right? If you would have bought, 10-year treasuries, we bought a 20-year treasury for all of our clients last year. And so we're locked in at 5.1% ish, somewhere right around 5%. I don't know the exact yield, but it's right around 5% for the next 20 years. So if nothing happens, they're going to clip 5% off that position. But again, this is what I'm talking about, is that, as the Fed starts cutting rates, we're likely to see a short term. We're between now and the first or second, third rate cut. We're likely going to see, inflation pop up, yields will pop up for whatever reason. There'll just be some reason why yields pop up. It'll be a news item. It'll be, some issue with inflationary pressures. Look like they're coming back, et cetera. So if we can get TLT as an example down to around 94, that's where all the buying was. Everybody was buying T-bills around 90, 92, 93, 94 on TLT. So if you get back to this level, that'll be a good opportunity to swap short duration for long duration. Now, I don't know if there's no guarantee we're going to get back down this low, but 94, 95, somewhere in there is probably going to be a decent neighborhood. And look, we are triggering a short-term sell signal. Momentum has clearly declined here just recently. We were very overbought, so we're kind of working off that overbought position. So again, there's a real reason technically why we should see yields creep up a bit, bond prices come down, and that'd be a great point to swap that short period or that short duration for long duration. The problem with waiting too long is that once this begins to really take off, if the economy slows more than expected, and if a recession really does creep up on the horizon sometime next year, yields are going to drop sharply, and the ability to swap at that point will be too far behind. You just won't be able to do it. And then you don't want to get into equities, because if recession is on the horizon, equities will be declining because equities are beginning to reprice for lower earnings because of slower economic growth. So again, that's where you get that trap, right? You're kind of stuck with nowhere to go.
All right. So I don't want to put words in your mouth, but it sounds like you're saying, hey, if we do get this near term jump in yields, prices come down, that may be the last time to jump on this train
For a while. Look, nothing goes straight up, nothing comes straight down. You go back in history, everything stair steps up and stair steps down, right? There's always opportunity. It's always the question, the best opportunity to buy long duration bonds was really October of last year.
right back
right?
when you guys did. Yeah.
Yeah, and that, because that's when yields were best. And ever since then, those yields have been recovering. It's been slow, it's been painful, but there's been a steady improvement, rising, higher lows, higher highs, and that's just a continuing process. But so there will always be an opportunity to make a swap, but at some point you may be swapping a maturing 5% 2-year T-bill for a 2.5% 10-year duration.
Yeah.
And there's also the other factor of this is that you have to factor in what is going to be the terminal rate for bonds. There's a maximum price appreciation that you're going to get out of bonds, and that's wherever that terminal interest rate is. So, for instance, if the economy slows to 2%, inflation comes down to 2, then 10-year Treasury bonds should yield about 2%. That would be your terminal rate outside of a recession. Now, if you get a recession or you shut down the economy, as we did back in 2020, that terminal rate was 0.5%. So, it could be lower, right, which would give you more price appreciation. But I think you have to look at this outside of the realm of either a financial crisis or an economic shutdown. In the norm of a normal recession, probably 1.8 to 2.3% of the 10-year is probably a likely terminal level for the interest rate.
Okay. And that's why I deliberately asked the question, hey, let's not think about recession for a moment, because this is a choice you need to make, even if the status quo continues here, right? And there are lots of reasons that you've just outlined to make this choice. So it's almost like, hey, there's decent reasons to make this choice, but you almost kind of get like this free option, almost like a warrant that hey, if a recession happens, this trade gets even much more appealing to you.
Correct.
Yeah.
Yeah, and look, we're going to buy more bonds. Again, we're just kind of biding our time. Our weighting is good. We've been, outperforming our benchmark index, so we're not pushed to do anything right now. But we do want, at some point, we will have 40% bonds in our portfolio. We will have 60% equities in our portfolio at some point. That's just not the case right now.
Okay. All right. All right. Well, look, a lot of other points about, some of the new data that's come out recently. I'll just note a few things. One, we got the PCE numbers today. And I guess the key takeaway from them is just that inflation is still sticky, right? So super core PCE actually ticked up a little bit. So point is, there's still a lot of arguments that disinflation is the trend and will continue. Just perhaps not
struggle.
Yeah. May take a little longer than folks think. And that may, again, for those that are expecting the Fed to come in and start cutting rates dramatically, it could impact the timeline of those rate cuts, obviously. I
think the big number out of the day though was income and spending, which is, income was up 0.3 and spending was up 0.5. So people are spending more than they're bringing home in income, which there's a limit to that.
That's exactly where I was going to mention next, and we can get into this more next time. But lots of data points like that. Personal savings rate hit like its newest low. We're back to like the lows of 2008 GFC. There's just increasing signs that the consumer is under stress, struggling, tapping out, whatever you want. I mean, there's not a day that goes by now where you don't see, a survey that says 3 out of 5 people say we're in recession, or the majority of Americans say the American dream is dead. We're definitely entering those points where I think sentiment is becoming increasingly vulnerable, right? Where people really start changing their behavior in ways that impact consumer spending, that then impacts GDP. You're nodding as,
yeah, absolutely. No, I got in a Twitter fight with a guy this morning who was says, well, nominal disposable income is still higher than nominal disposable expenses. And I'm like, you can't, that's like comparing a Volkswagen Beetle to a Formula F1 race car. Yes, they're both cars, but after inflation, they're drastically different.
Yeah. And just to be clear, I get asked a lot by people, hey, bring in more bulls on the channel, or people who aren't so bearish. And as we've talked about many times, I have no idea what these people are going to talk about when I bring them on. I don't select for what they're going to say. I select for people who are data driven and they come make their case. Now, a lot of people are concerned, but if you want to hear, somebody argue the case that, hey, things aren't that bad. In fact, the middle class is actually doing pretty well right now. Go watch the video I did with Wolf Richter from last week. He very much goes through that. And Wolf, what I appreciate about Wolf is he does the job you expect him to. He's a German. He's a just the facts guy. He tries to take a very Vulcan approach of things. And, he does say some things that we have to be, we have to take into account where, I was digging with him about, the difference between the mean and the median and is the economy being propped up by that rich top 20% that can still spend? And if so, how long can they do that for and all that stuff? And the middle class, everybody else is increasingly struggling. And he did a good job of bringing up some counter data points, but basically just said, hey, look, he's like, I've been looking for a recession. I expected a recession to arrive a long time ago, but I don't see that it's arriving in the data. And until I do, anybody that says we're going into recession tomorrow and positions for that now is potentially putting themselves at the risk of getting steamrolled by the continued growth of the economy here. By the way, they just, we got the initial estimate of Q2 GDP at 2.8 and talked about how usually when the revisions come in, it comes down. Well, the latest revision that's now bumped up to 3.0%.
But there's a big but on that. There's like a JLo but on that data point. Because there was a massive upward revision in PCE that really doesn't jive with the data. So, again, and we see this happen, these anomalies in the data happen for one reason or the other, and they get revised out later on. And we don't care about the revisions. Like, it's like employment, right? We revised employment, 818,000 jobs less than what we thought we had, but market doesn't care, right? That's as I wrote in one of my newsletters. If you ever watched the movie Gumball Rally, remember that from the day with Burt Reynolds and Dom DeLuise, and it's about a race car race across the
Cannonball
country.
Run.
No, there's also one called Gumball Rally.
Oh, I never even heard of that.
So anyway, Raul Julia plays an Italian race car driver in this movie. And his line is that, the one rule about being an Italian race car driver, and he reaches up and he rips the rearview mirror off the windshield and throws it out the car. He says, what's behind me is not important. And that's kind of the view of the market. We have these revisions, but it's behind us. And so the market's looking forward. But I suspect that this PCE, and again, when you take a look at retail sales, and I did this article last Friday, on the website. If you take a look at retail sales as a good example of this, there is, the data right now is showing that this is real retail sales, right? So even though retail sales are rising and people are spending more, they're buying the same amount of stuff on a real basis. And whenever you've had these flat periods of retail sales, those have always preceded a recession. Historically, the data, by the way, the data for retail sales only goes back to 1992. So there is a bit of, bias to the data from the fact that it's just, we don't have a lot of it. But, previously, this does suggest that the economy is continuing to struggle. And when you see these massive revisions that occur to this data on a real kind of regular basis, you have to look at, when you see these kind of outliers of events in the economic data, it's important to look back and say, okay, let's pin that for a moment and let's wait for the next revision. But I suspect that probably when we do the annual revisions to GDP or the 3-year revisions to GDP, we'll come back and that number will be revised lower, because the other data, retail sales makes up 40% of PCE, which is 70% of GDP. Retail sales do not support that jump in PCE because that's 40% of it.
It's funny. I kind of feel like you're taking on my more, general pessimist's hat in this week's discussion. No, I know.
No, not at all. And look, this is my job, right? And look, I have to manage money, and I invest capital, and I have to understand what the risks are. So, I know I chastise you sometimes about being too bearish, and, that's okay. But we do have to understand that there is risk to the economy, and we need to be aware of that, because economic risk, look, there's not going to be a massive recession. We're not going to have a financial crisis. The dollar is not going to collapse. The world is not going to end, and being in a bunker is not going to be a good thing for you. But that doesn't mean that we can't have an economic slowdown or sub 1 to 2% economic growth next year because of the extraction of all this monetary liquidity from the economy. Slower economic growth is going to lead to slower earnings growth, and markets are not priced right now for slower earnings growth. So you have to be aware of that potential economic risk that's out there, because economics drives earnings and earnings drive stock prices.
All right. That's actually really well said. I think I might actually make that the teaser for this week's video. All right. Well, look, I'll just wrap up by saying, if you want to hear the defense of the, hey, things aren't so bad, go listen to the Wolf Richter one, and even the real retail sales you mentioned there. Yeah, they're flatlined, right? Or they flatlined, but they're not puking, right? So some people might call that holding in there as opposed to, doing poorly, right?
And look, and I admire Wolf. I think he's a great analyst. I think he does a great job with the data. So I'm not arguing with him at all. I think he's right. I think the consumer's doing fine right now. I just think that looking at the data, more and more Americans are just struggling to make ends meet. And that's a function of time until they can no longer do that.
Yeah, and I completely agree with that, which is again why I keep beating my drum, particularly the lag effect one. All right, well, look, as we wrap up here, I wanted to get to the rant part. I wanted to give you an opportunity to vent if there were things to vent about from the moving process, because as anyone who has ever moved at any time, anywhere, moving sucks. How are you doing? You still married?
Yeah, no, look, so two lessons. So quick recap if you're new to the show. A little over 2 years ago, 2 years and 2 months ago, my wife and I sold our house. We used to live in Katy, which is a suburb of Houston, Texas. And the reason we lived in Katy is because they have really great schools, public schools. And I'm too damn cheap to pay for private schools. So we moved to Katy so our kids go to really good public schools. So we lived out there. We did the whole suburb thing with 4 kids and, commuting an hour back and forth to work and all that. So when our kids, graduated college, graduated high school, our oldest son is now in Germany, who, by the way, just graduated engineering school. He landed a job with Siemens. So he's doing very well.
Congratulations, Dad, and to him. Yeah.
Yeah. So we're very proud of him. Now, the other 3, not so much, but I got two that are juniors in college. I got a senior in high school. So anyway, we sold our big family house that we had out in Katy. And my wife and I moved into a rental for the last 2 years because we were looking for a house that was a lot smaller, that we could kind of remodel and make it's not our forever home, because this won't be our last home, but we're going to be here for a while. So we wanted to find a house that we could actually remodel and kind of make it the way we wanted. I've never remodeled a house before. I will never do this again. And I highly encourage you to never do this. But this house that we bought, and someday I'll have to give you a video tour of it, I guess. We ripped it down to the studs and completely. It was built in 1967. It's a 2-story house that we literally ripped down to the studs and redid everything. So it's funny. I tease my contractor all the time. I was like, I don't know what takes you so long, because I watch these shows on television and they remodel a house in 30 minutes. So I'm not sure why it's taking you 8 months to do this, but you learn a lot. I've learned a lot about remodeling a house. I've learned a lot about the do's and the don'ts. So if you ever decide to remodel a house, send me an email and I'll talk you out of it. But, it was a great experience. My wife has look, and let's be clear, Adam, I'm a guy. I could live in a 1-bedroom apartment. I would be completely happy, right? I don't have a lot of stuff. I need a computer. I need a television. That's all I need.
Fridge, yeah.
And a fridge, and oh my guts. But other than that, I don't need anything else. So this house is my wife's house, and so it has been remodeled to her specifications exactly. And the big challenge right now, the big challenge is her. I was talking about this on the radio yesterday, is that she has this KitchenAid mixer that I bought her when we first got together like 15 years ago. This thing probably it's got to weigh 100 pounds. If it weighs a pound, it weighs 100 pounds, right? This is one of those KitchenAid mixers that basically put the right attachment on it. You attach it to a back of a flat bottom boat and it propels the boat, right? It's just that kind of a mixer. or you attach it to a body and it'll solve your problems. But she wants to put it on this shelf that will lift it up because it's too heavy for her to lift. And so she talked to the contractor and she's like, oh yeah, they make those shelves and you know, you put the shelf in, it's got a little hydraulic lift on it, it lifts up. And I'm like, great, this is awesome. My wife will be happy. Well, they put this mixer on it, the mixer's too damn heavy for it. So they're having to figure out how to get more hydraulic lift out of this thing to lift this mixer. So that's been the antics, of course, has been over the last week is them trying to solve this one mixer problem in the house.
Wow. Well, congrats. And it's nice to see the new environment behind you, but this is temporary too, right? This is not your main studio?
No, no. This is not my studio. The studio is most of the media equipment and the video equipment was installed yesterday, but my friend, so let me give you, let's talk a little bit of, let's have a little lesson. And I hope my carpenter does not see this video because I want to give you a lesson about what not to do in business, because this is a young guy. He's, you know, we talk about the Gen Zs and the millennials all the time. He's a young guy. He dropped out of college because he was going to get an architectural degree. Really smart guy. He lived up in Austin, and you know, if you know kind of the Austin vibe, so to speak, it leans a lot to the left. And so there's a lot of these kind of mental, you know, thoughts about the way life should, you know, the way people should be treated and the way life should be. And, you know, so he's decided he wants to, but what his passion is to build cabinets. And I will tell you, the guy is a phenomenal cabinet maker. In fact, this wine rack behind us that is something he built, and he built it for my wife, and he does phenomenal work. So when he built this, I said, this is great. I want you to build some cabinets for me for my office upstairs. And I need them by last Friday. It was supposed to be the date was last Friday so I could do the show review. And he had a mental health problem that kept him from working for an entire week. Then he came down sick, which he ate some bad food. So now he can't work because his stomach hurts. We're now 2.5 weeks past the deadline for the delivery of the furniture, right? Now, I'm not, you know, so the point I want to make to you is if you go into business, this is one of the challenges of business, which is come rain, shine, sickness, health. If you make a commitment to deliver something, a product or a service, it is incumbent on you as the business owner to make sure that that product or service is delivered on time, which means that if you can't do it yourself, you hire somebody to do it for you, even though that eats into your profit margin, right? So here's his problem now. I think he is a phenomenal cabinet maker. I think and when he first started working, he was like, man, I think this kid's going to go someplace. And I'll recommend him to all of my friends because I have a lot of my friends that are in different trade industries and different construction, building managers, interior designers, etc. And I'll recommend this guy to them, and he'll have more business than he can shake a stick at in no time. The problem is now is because of his actions, I will never recommend him to anybody. So, you know, so this is, you know, one of the valuable lessons to learn. And it's the same thing with my business, and Adam, it's the same thing with your business.
Yep, absolutely.
If I don't deliver performance, I lose clients. If people email me and I don't email them back, or if my clients call me and I don't call them back, or I say, oh, I'll get to you later, I won't have clients. You know, if I don't communicate, I don't have clients anymore. So it doesn't matter whether I'm overseas on vacation or if I'm sick or whatever it is, I'm still working. I'm still performing as needed to make sure that my business runs as it's supposed to run, because the business doesn't care about how I feel. The business doesn't care about what I think about today. And my business doesn't care about whether or not I feel good or whether or not I'm depressed today or not. The business doesn't care. And the survival and success of that business is dependent upon me performing a duty and a job, regardless of the underlying circumstances. So I know that sounds harsh. It's like I should be forgiving. The fact is, yes, I understand you were feeling depressed for a few days and you didn't feel like working. I should understand that. I get that, right? You know, you're sick. I get it. You don't feel well, so you don't want to work today. Hey, I should understand that. No, I don't have to understand that. I'm the customer. I've already paid for this furniture to be delivered, and I had specific requirements when he accepted the job and the contract. I had specific requirements for that delivery. He should have compensated, either A, compensated me for not having what I need, in other words, giving my money back so I got to hire another furniture maker, or figured out some way to make sure that was delivered on time, whether he could do it or not. But these are valuable lessons that if you're going to start your business, these are the things you have to go into with the right mindset. The business is not going to forgive you for long for making simple mistakes.
So I'm sorry you had to go through that. I appreciate you telling the story. I think it's a very important one. And you know, a lot of people feel like, okay, if I just get really good at something, right? If I can build the best mousetrap, the world will beat its way to my door. And we've talked in the past about how talent will only get you so far, right? And even if you build the best mousetrap in the world, as they say, 20% is getting the product right, 80% is getting to the hands of your target customers, right? So if you're
Right.
bad at marketing, right, even if you're a great product developer, you're likely not to be that, as successful. You're talking about another really key critical component, which is mindset, right? Is I can have fantastic entrepreneurial talents, but if I'm not marrying that with the correct entrepreneurial mindset in terms of being dependable, in terms of honoring my word, things like that, hitting my deadlines, whether it's me or I find somebody else to do it if I'm not able to do it myself. As you're saying, that can be a total, game killer right there. And like you just said, you were a conduit to a bunch of future business for this guy, probably not going to materialize anymore. So if you're one of our younger viewers, really do take this to heart. In fact, I think you can get a lot farther with a good mindset and average talents. If you get a great mindset and a great work ethic, but average talent, that's going to take you really far. If you've got all the talent in the world, but a poor mindset, you're not going to succeed for all the reasons that Lance has just mentioned here.
Yeah. So anyway, I don't mean that to sound harsh, but I just think it's
But it's
this.
real, and I think that's the value you're
Yeah.
delivering here, which is, hey, there are
Right.
some hard truths, and better you know them, right?
Yeah.
And same
So
thing if you're a parent. Again, both Lance and I, but I think a lot of folks watching here, have children that are launching into the adult world. And as we've talked a lot about, in the past, we've talked a lot about pushing our kids into adversity because they have to learn how to overcome them, right? When they're getting out in the real world, we have to, we really have to push them into the hard truths, because if we don't, they're just going to slam into them head first and then pay the consequences, like it sounds like this kid's going to do. Let me wrap with this story because it's somewhat related. I have an older daughter who is now, out there finding her way. She's investigating a bunch of different potential career paths right now. And there's one that she's really excited about. And it's kind of a non-traditional path. And she is working with a very small organization that she really likes. And the main person running the organization, main guy, I don't want to get too specific, but sort of did some inappropriate things to her, said and did some inappropriate things to her. And she called us and said, "Oh my gosh, like I don't know what to do. I really love this job, and this guy's totally connected in the field I want to be in. He's been opening all these doors for me, and I'm afraid I'm going to put all that at risk. But what he's done isn't cool." And we basically said, "Hey, look, we get it. And by the way, welcome to the real world, right? There's going to be lots of human elements like this you're going to have to deal with. And you've got to make a decision right now. You're either going to draw hard lines about what you're willing to accept and what you aren't, or you're basically going to bend your principles. And if you do the latter, you're likely putting yourself on a path where people will realize they can get away with things they shouldn't. And that's going to become a pattern in your career." And to her credit, I give her a whole bunch of credit for this. This is kind of tough to do at her young age. She went and asked this person to sit down and said, "Hey, look, I'm not going to, maybe I'm reading this the wrong way. I'm giving you an opportunity here to sort of explain yourself or tell me I'm looking at it wrong. But here's what happened. Here's how I interpreted it. This is a hard line for me. And if this line's going to continue to be crossed, I can't continue working here. And happy to say in her case, it worked out really well. The person was very apologetic, said I wasn't really thinking and I wasn't really seeing how it was affecting you, and has promised, hey, I'm never going to do this again. And she'll probably have a much better experience going forward because this person will be really attentive to not even approaching that line anymore. We'll see. But again, this is where, you know, her choosing what mindset to have is, I think, going to be, you know, critical to her trajectory from here off. So we're very happy with the decision we've made. Hopefully it has the outcome that we want. But again, mindset is crucially important.
Yeah, I mean, look, you have to, you know, the most important thing about success in her case, or in this particular gentleman's case that we're talking about, is, you know, adversity, and you've got to be able to face adversity and overcome it. And how you choose to do that will define not only who you are, but how successful you will be or not.
All right. Well, look, Lance, thanks so much, my friend. Folks watching, if the definition of success for you is getting to hear Lance's wisdom of life week after week on this program, please let us know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. We talked a lot of issues this week. But folks, if you are looking for help in navigating the road ahead, particularly if it follows the projected course that Lance, you know, has mentioned he thinks it may from here, if you'd like help navigating your financial wealth through that, work with a good financial advisor. But if you don't have a good one, or would like a second opinion from one who takes into account all the issues we've talked today, maybe even Lance and his team there at RIA, consider scheduling a consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the short form at thoughtfulmoney.com. And the advisors that you're matched with will be in touch with you very swiftly after that. Just a reminder that we're now about a month and a half away from Thoughtful Money's Fall Online Conference coming up on Saturday, October 19th. I've given you the long list of the faculty here on this program several times already, so I won't go through it again now. But if you're interested in attending the conference, or at least learning more about it, go to thoughtfulmoney.com/conference. If you haven't registered yet, but know you want to attend the conference, do so soon, because I want everybody who can to lock in the lowest early bird price discount, which we're still offering. And a reminder, if you're a premium subscriber to our Substack, you get an additional $50 off of whatever the ticket price is for the conference. All right, Lance, as usual, I'm going to let you have the last word, buddy.
Never remodel a house.
Okay.
No,
Okay.
no, it's look, everything's fine. You know, I certainly suggest that, you know, if nothing else, you know, cruise by our website every now and then at realinvestmentadvice.com, download the daily market commentary. It'll kind of keep you on track for where the market's headed, you know, kind of in between these conversations that Adam and I have. But look, the market's fine right now. But again, there are certainly some concerns over the next month or two as we head into the election. And we didn't get to the article today, but I think there's a reasonable risk of another pullback, you know, 3 to 5% between now and the election.
All right. Well, we'll get that flag. We'll get into that next week. Lance, buddy, always great. So glad that you've made it through the whole house saga. Looking forward to seeing your new home studio once you're fully squared away and all that. And see you next week, buddy. Everybody else, thanks so much for watching.